Hey, happy Monday, and thanks for checking out this week's market update for April 24th, 2023. Right now, mortgage bonds are up about 15, 18 basis points, depending on when you're looking. And if you're just starting to learn about this stuff for the first time, when mortgage bonds are up, it generally means that mortgage rates are improving. And when mortgage bonds are down, it generally means that mortgage prices are getting worse. So far, pretty good start to the week as far as mortgage-backed securities go. As far as rates and where we currently stand at the moment, we're pretty close to where we were last week, up a tiny little bit, maybe an eighth of a point. And on the on the government side, maybe as much as a quarter of a point worse, just because we're seeing the VA, FHA, and USDA rates a little bit worse than they were a week ago at this time. So the one thing everybody seems to be talking about right now is loan level pricing adjustments. If you haven't heard what happened, the FHFA came in and made some changes, and now you're going to see pricing on Fannie Mae and Freddie Mac loans, or as we call them, conforming loans. Some of the pricing adjustments are going to change. I'm not going to go into a lot of detail because, for one, it's been done to death, and two, honestly, it may just confuse you if you're not a licensed mortgage professional. The end result is this: for some folks who are going to buy a house after May 1st, they may find rates a little bit more expensive based on their certain loan criteria, and other folks may find the rate a little more affordable based on certain criteria. What I think this means to you as a buyer is make sure you are working with a professional, an educated, experienced loan officer. And here's why I say this: because depending on how you structure that loan, some of these changes may not impact you. But if you're working with a loan officer or a mortgage professional who is simply an order taker, someone who you just sit down with and you say, I need a mortgage to buy this house, and they look at what you have in the bank and go, here's your loan, here's your 30-year fix with 20% down based on your 740 credit score, that's not helping you. There are a lot of different ways to cut up a loan these days. There's different ways to structure even just a conventional conforming loan, depending on if you put 20% down or 10% down or 30% down or 5% down. You're going to see significant disparity and difference along your pricing. And not every loan officer is going to take the time to go into that level of detail and show you A, B, C, and D. I also think you want to make sure that you look at all available loan options instead of just looking at right away a vanilla 30-year fixed conforming conventional loan. Maybe take a look and see what FHA looks like. I'm not saying FHA is the greatest loan program out there. I'm not advocating one over the other. I'm simply saying that make sure you look at all your options, because I'm coming across an increasing number of scenarios where FHA loans are having a significantly lower monthly expense for that client to buy that house than the conventional counterpart. So make sure you're being offered both. A lot of loan officers, again, your order takers, they're just going to look at your credit score, and if you're above 620 or 640 or whatever their minimum is, they're just going to throw you in a conventional loan and not even explore the other option. Another thing to keep in mind, there are some programs out there that not all lenders do, where depending on where your income is, your qualifying income on your mortgage, depending on where that income is relative to the area median income where you're buying this house, you may not have to worry about some of these loan level pricing adjustments, and simply due to your relationship to the area median income, you may actually have discounted pricing. But lenders have to seek out and apply a specific program to make sure that you get that discount, you get the discounted pricing. Not all lenders do it, not all lenders offer it, not all lenders pay attention for it. So again, in this environment where things are changing so rapidly, and because affordability is stretched so thin because of rates, every little bit helps and every little bit counts. So make sure you're working with somebody who's willing to delve and dive into the details with you. So we're going to have some data coming out this week. We're going to have some housing data. We've got Case-Shiller and the house price index. It'll be interesting to see where that comes in at. And also on Thursday, we're getting the PCE. In our last week's update, we talked about the CPI, which is a report that measures inflation by tracking a number of goods and services and where their prices move to gauge where inflation's at. That was the CPI. This is the PCE. The PCE is very, very similar, but some of the weighings are different. For example, in the CPI, housing is a big piece of that. We have shelter inflation going on. We talked about it last week. That takes up about 42, 43% of the CPI. The PCE is a little bit different. I want to say it's around 20, 26%. I forget the exact number, but it's a little more than half of what it is in the other index. So it still matters, but if those numbers start to come in a little lower, we're not going to see this huge, gigantic, drop in rates. But it would be nice to see something move the market one way or another. Other than that, we're really just kind of in a holding pattern until May 10th. As we've said in previous updates, we think that's going to be an inflection point where we start to see shelter inflation come down. We start to see the year over year figures look better on the CPI. And hopefully that starts a little bit more of a resuming our downward trend in rates. That's about it for the week. If you need anything, feel free to reach out to me. These are my socials. And if you need to get in touch with me direct, here's my contact information. I hope you have a great week.